Hello, this is the CIO Weekly Update from Emirates MBD. I'm Gary Dugan. Well, markets have not moved very much over the last few days, but there's certainly been a lot happening in the background. First point we'd notice is the pickup in inflation around the world. In fact, some quite dramatic increases. In the case of Korea, for example, inflation hit 2%, up from 1.5% expected by the market. Also, some of the surveys are showing inflation pressures building, particularly in the United States. However, markets have taken this in their stride, even if we're seeing some of the biggest economic surprises of inflation around the world that we've seen in the last 3 or 4 years. Certainly the Fed's not that worried. Their most recent meeting and what's called the FOMC comments immediately afterwards suggested that they're more confident about hitting their inflation target, but are not so worried that inflation is going to bust through it and rise spectacularly. Bond markets therefore have taken it all in their stride. 10-year yield in the US remains comfortably below 2.5%, with seemingly little appetite on the part of investors at the moment to push yields that much higher. We do believe in the balance this year that inflation risks are still out there and that bond yields could still rise further. So be aware of that, but in the near term, some comfort for bonds. Well, that comfort for bonds is not really playing out in terms of much upward surprise on equities. And indeed, equities from here could have something of a setback as the news flow of excitement around Donald Trump is not a positive one, but more of a negative one. The concerns that Donald Trump can't even get his immigration policies to stick are making Wall Street worry that he won't get his fiscal policies to stick. And hence, a lot of the excitement about upgrades to earnings forecasts and better growth are really not coming to pass. Indeed, in the last 1 to 3 months, we have seen profit forecasts being cut by Wall Street, not increased. And therefore, there's something of a bit of a disconnect between the rise in equity markets and the lack of rise in corporate profits. Elsewhere around the world, much better news. In India, the delivery of a good budget, still focused on reform, some tax cuts for the low paid, and ongoing improvements in digitalization and the general infrastructure of the country is all good news. And that's a market we remain very much committed to. Back in the old world, a lot of noise in UK Parliament around the Brexit issues, but Article 50 now looks like it's going to happen, which means that the path will be set for the UK to leave the European Union 2 years from now. And to end on a couple of notes, firstly, geopolitics in Europe certainly started to stir, with the National Front candidate, Marine Le Pen, leading in the polls, at least in the first round of those presidential elections coming up in April. Something of a challenge for the euro. And finally, don't forget the world is aging, and this is the challenge longer term for the global economy. Recent economic data out of Japan showed that under age 60s, below the age of 60, consumers were increasing their spending, but those above 60 were cutting their spending. So there's a big difference between those who can still be in jobs, still enjoying wage growth, and those that are in retirement and facing the challenge of making their pensions last for their entire life. So we still think global growth longer term has its challenges. In the near term, a bit of a mixed picture, but for the very, very near term, equities to have something of a setback and bonds to hold in. Thank you.